benefit of the listeners to understand that what an ARM is. So in a period of rising interest rates, the bank, the lender, is worried about future rates, obviously, because that's going to cut into their profitability. So if today's rate's 5.25 on a 30-year fixed rate, in ARM, that rate might be, I'm not a lender, but that rate is going to be way lower than the 30-year, because the bank is going to say, look, I'll borrow money at a lower rate for a short-term period rather than, and make some money here. That way I can get the buyer in. So let me give a better example of that. What is the impact of a 1 full percentage point up? So we went from 4 to 5 just for practical purposes. Well, on an average, our average median price, 450, 400, somewhere in there. But on a $500,000 purchase price, you're talking about a mortgage payment that could be about $500 higher today, April 7th, than it was in January. And, for most of us, there's not many of us that can absorb a $500 increase on our monthly payment, without having to lower the price, obviously. So what an ARM does is it's going to say, look, today's rate's 5.25, but if you take a 10-1 ARM, I might be able to get you in a 3.25 or 3.5. Now, again, these rates are going to move. I'm just trying to, give an example. And what an ARM means is that my rate is locked for 10 years on a 10-1 ARM. So that means I'm going to get a 3.5% interest rate on my mortgage, and that is locked for 10 years. And most ARMs, there's no prepayment penalty, so I'll have the ability to refinance whenever I want. There's absolutely no hidden fees. The process is the same. The inherent risk is on the 11th year of the mortgage, my rate is going to reset. And it's going to reset to what the current market conditions are. And there's a whole bunch of other stuff we can get into, which we won't, but that's the basic of it.